Good morning, everybody. And welcome to our webinar this morning. It's great to have you all join us for our first webinar of 2022. My name is Alan Merritt, Head of Retail Distribution at STANLIB, and it's great to have you all join us this morning. For all of you who had holidays and took breaks over the festive season, I hope you had good quality time with family and friends, well rested and ready and looking forward to the year ahead. As you can see, I'm in a slightly different environment today, so I've actually decided to come into STANLIB, into our head office in Melrose Arch, to give it a change and to give it a try again. As you can see, we've kind of changed our setup here, but still very, very quiet. So even coming into the Melrose Arch precinct today, very, very quiet. And I suppose that's just one of the kind of side effects and the impact of the COVID-19 pandemic on the office market, etc., which we'll touch on a little bit later today in our presentation. Today, just to position today's presentation, I have the pleasure of being joined by Mphaphuli, the head of our fixed income business at STANLIB, as well as Nesi Chetty, who's the head of our property business at STANLIB. It's great to have Vic and Nesi join us today. And today we're going to be giving yourselves an update across fixed income markets and the asset class as such, as well as the listed property sector. And we're going to be doing that through an update and a discussion and chat around our STANLIB Flexible Income Fund. So as an industry, we've continued to see strong flows into multi-asset portfolios, and specifically kind of low equity multi-asset funds like our STANLIB Balanced Cautious Fund, but as well as funds like our STANLIB Flexible Income Fund, the multi-asset fixed income fund in our stable of portfolios, which sits in the same sectors the likes of the Coronation Strategic Income and 91 Diversified Income Fund, for example. So thanks to all of you for the support into the propositions. We really do appreciate it, and we hope that we give you a good update on those portfolios today. So to go into a little bit more detail on what we're going to chat about today is if we look at the kind of the start of 2022, the end of 2021, obviously you had the fourth wave of the COVID pandemic with the Omicron variant in South Africa. We've kicked off the start of 2022 with a lot of volatility and uncertainty, concerns around inflation globally, how central banks are going to react to potential impacts and changes to the interest rate cycle, and how these and other risks potentially are going to knock on into the market and have an impact on asset classes and potentially portfolios. At STANLIB, our teams and our investment team focus consistently on being on top of these kind of changes, how they need to look at asset allocation, changes across asset classes, look to manage risks, obviously, in these portfolios, but also look through these times of uncertainty at potential opportunities to try and generate returns for your clients to obviously meet your and your clients' investment objectives. So to bring it to today's presentation, we're going to kick off shortly with Victor. Vic's going to give yourselves an update across the fixed income market from a macro perspective, touch on inflation, interest rates, potential changes and what central banks will be doing, touch on the South African fixed income market as well, and then bring that back into the flexible income fund in terms of how he and the team have looked at the asset allocation within that portfolio historically, and I think very importantly for yourselves, how we're looking going forward from a flexible income perspective in terms of asset allocation in that portfolio. Vic will then hand over to Nesi. So Nesi will then touch on the property sector within the context of the asset class within our flexible income fund. So Nesi will touch on the domestic property sector, look at some of the subsectors and give yourselves an update on our views. Obviously, properties run extremely hard and strongly in terms of returns during 2021. And importantly, what is the outlook going forward across the listed property sector? Vic will then give a very brief update after Nesi just on the flexible income fund and our views going forward, just in a wrap up on the portfolio. And then we'll go into a Q&A. So please pose your questions via the Q&A functionality. The chat functionality is turned off, but just through the Q&A functionality. We're hoping to leave around 20 minutes or so for a Q&A with Vic and Nesi. Just from a normal housekeeping perspective, we are hoping to be finished by 11 o'clock this morning. So for those of you who are looking for CVD points, please remember to stay logged in to the call webinar for the entire period. We will be sending a recording out as well after the webinar. So yeah, so this is a little bit of housekeeping, but I'd like to hand over to Victor and hope all of you enjoy the presentation. And once again, thanks very much for joining us. We appreciate it. Thank you. Over to you, Vic.
Okay, thank you very much, Al, for the wonderful introduction. As Al mentioned, I'm going to be providing a broad perspective around the macro themes, that are going to have an impact on fixed income markets in South Africa, but also globally. So, I mean, as most of you, I mean, would know, we've been going through a very tough environment from the time when the pandemic started. However, I mean, as the whole situation progressed, it has even become even more difficult, I mean, for portfolio managers to manage the environment. Especially last year in 2021, when we were no longer just talking about liquidity being pumped into the system, we were now talking about inflation, but not just inflation, but we were also talking about the type of inflation that's going to play out, whether it's going to be transitory or whether it's going to be permanent. And a lot of portfolio managers, I mean, have took a lot of guidance, I mean, on what for example, the U.S. Federal Reserve, I mean, would have been choreographing, you know, to the market. And as a result, we saw U.S. Bond yields, I mean, rising today. I mean, even moving even to higher levels. And as that happened, because of the correlations that emerging markets have, you know, with U.S. bond markets, we also saw our yields also moving higher, I mean, to levels where we are currently sitting. 2022, it's still going to be a challenging year. We're no longer just going to talk about inflation, but we're going to be talking about central bank as reaction to the inflation, given that it's now well accepted. I mean, that the central banks have actually, or they look like they've fallen behind, I mean, in terms of the response function to that. So there are four broad themes, I mean, that I'm going to touch on, which will lead to our fair value on bonds, basically, I mean, where we think the bond yields will basically end the year. And these four themes are really around, as I mentioned earlier on, you know, around the U.S. Federal Reserve and other G10 central banks, where they are going to be looking to reduce their balance sheet. But not just that, moving forward, I mean, the other type variables, I mean, for tightening conditions, including interest rates, and also starting to talk about quantitative tightening. So that in itself, I mean, can have an impact, particularly on emerging markets. And then I'm also going to touch on the fiscal story. I mean, we saw the medium-term budget statement presented last year, which I thought it was quite credible, but a lot of it is going to depend on whether we are able to deliver on that. And if we are able to deliver on that, it can create a sustainable debt path, I mean, for South Africa. As a result, I mean, we have already seen Fitch, one of the rating agencies, coming out, changing the outlook from negative to stable, I mean, which is quite a positive. And then to add on to that, you know, we also have the local rates issues, which is going to be driven by inflation globally, but also inflation locally. I think most of you, I mean, would have seen the number that came out today, inflation at 5.9%. I think markets were looking for that number to be at 5.7%. What does that mean? I mean, in terms of the Reserve Bank's response function to that. And then the last item that I'm going to touch on is, given all these things that I've talked about, the global environment, the fiscal space, the interest rates locally and also globally, what does it mean, I mean, for South African bonds, and where are South African bonds, I mean, sitting from a valuation point of view, you know? Is the premium that the market is trading at enough to be able to reduce, I mean, some of the volatility that might actually come through? As I said earlier on, last year was all about inflation, as you can see on these two graphs. The graph on the left basically showing a real Fed funds rate getting into way negative territory, meaning that at some stage, I mean, the U.S. Federal Reserve, as expected, they are going to be looking to increase rates so that they can get as quickly as possible to the neutral rate. Because if they don't do that, then they're going to have a problem where real wages, I mean, probably stay at negative territory. Whereas, I mean, if you look at previously, I mean, most of that has always been on the positive side. So the risk on the wages side is that if inflation stays elevated for longer, inflation expectations can start to anchor at higher levels, and then that can have an impact on global yields. And we have seen some of that, already starting to play. When we had the pandemic, everybody was worried about deflation, for example, and most yields, globally started to trade into negative territory. There was a time when about $18 trillion, of money invested in fixed income was sitting in sovereign bonds that are yielding a negative. And that's because markets were worried that about deflation. However, as time progressed, inflation became the main topic. And as a result, we're starting to see the reversal of those investments in negative yield territory. And maybe one market that I can use to show is the German bonds market, where the 10-year bond yield is now tracking towards zero level. After staying since around 2018 in negative territory. And this is a clear indication that the markets are no longer worried about deflation, but are worried about whether inflation can be contained or not. So one of the big risks that everybody talks about is if the US is going to make a move on rates, what impact is this going to have on emerging markets? My view is that it depends on how that play is choreographed. If it's one that comes with a lot of surprises, simply because maybe they are falling behind the curve quite quickly, then it can be quite negative, for emerging markets. But if it's one of a gradual approach, where the message gets choreographed in a not so aggressive manner, then that can actually still, protect, some of the flows that end up, going into emerging markets. But nevertheless, I think the main message here is that we are in a different environment where rates, by March, are probably going to start to move higher, where by March, they are probably going to finish, tapering on the balance sheet. And now they are also starting to talk about quantitative tightening. Hence the response, that you would have seen in the US treasuries and also, some other emerging markets, following. The reality is that depending on how that happens, if the dollar gets too strong, it does have an impact on flows, that basically go into emerging markets. We saw this, post the global financial crisis. So if you look at South Africa, what is it that can actually protect us? Okay, there isn't much that can protect us if the response function from the global central banks is one of surprises. Like when I say surprise, an example being, instead of hiking by 25 basis points, they hike by 50 basis points, or maybe they hike much higher than what would have been previously expected. Then even the premium, that South Africa has been building over time, might still get affected, particularly in the short term. But if we follow a gradual path that is well choreographed, a country like South Africa, has got a very high inflation premium, that has actually been building over a period of time. And this in itself, South Africa makes South Africa quite attractive, especially, when flows, start to look for higher yields. So this can actually become quite beneficial over time. But most of this, it's also going to depend on what South Africa as a country also does, in managing its fiscal space, which I will talk about, a little bit later on. So what you're seeing here is what the Reserve Bank or the markets basically are expecting in terms of interest rate hikes as a result of inflation starting to nudge, a little bit higher. So the blue lines basically being how aggressive markets are expecting interest rates, to move over the next 12 months and over the next 18 months. And the red lines being what STANLIB is basically expecting. So our expectations of rate hikes, we are saying that there's going to be rate hikes, but we are not as aggressive as what the market is looking for. Also, simply because the economy still does need a little bit of support, from the Reserve Bank. Of course, this can change, especially if the response function, from global central banks is basically one of surprises, of huge surprise, and if it creates, a lot of volatility. So South Africa doesn't have to be too aggressive, because from an inflation expectations point of view, that's still benign. I mean, if you look at our core inflation, it's also, I mean, in the mid 3%, meaning that the economy is still struggling, I mean, to grow. So it does need some support. So as a result, with bond yields currently sitting around 10%, I mean, currently, and inflation maybe around 5.7, probably maybe by the end of the year, maybe averaging around 5%. There is still a huge gap, premium gap. I mean, that basically, I mean, protects investments, I mean, in South African bonds. So the other best way to look at it from a valuation point of view is where we compare South Africa, to other emerging markets and also maybe some developed markets. What is clear on this graph is the gray bar that you're seeing there on the right. South Africa's real yields are actually quite compelling in comparison to other countries. So if everything over time, I mean, becomes stable, then I mean it does make sense. I mean, for investors to start looking at countries that have got compelling yields. Even if you were to buy South African local cash bonds, hedge them out, I mean, for the currency, and obviously present the results in dollar terms, South Africa's yield is still one of the most, I mean, compelling ones in comparison to other emerging markets. So this will come in quite handy, especially in an environment where there might be a lot of frostiness. I mean, when the central banks start increasing rates. But we also need to get our house in order. As I said earlier on, we saw the medium-term budget statement, which has actually reduced, I mean, the debt trajectory to a credible level. And we saw Fitch basically changing the outlook from negative to stable. I think the only rating agencies that is still at risk is Moody's, because they've got us on a negative outlook. But if we can manage this fiscal space and aim to achieve the fiscal consolidation, that is going to be quite positive, I mean, for our markets. So everything being said, I mean, and the premium that I've talked about earlier on, and where South Africa is trading, I mean, we think South African bond yields are attractive at around 9.9 or 10%, I mean, on the 10-year bond. And I mean, we think that should basically, I mean, trade lower to 9.25, giving us, I mean, a total return of about 15%. But like I said, I mean, the proviso for this is whether the response function, I mean, from the global central banks is going to be one of gradualism, or is going to be one of we are falling so far behind and we have to do anything possible to make sure that we arrest this inflation. I mean, that we have misunderstood for quite some time. So as a result, in an environment like this where there's still going to be volatility, we've got a portfolio, I mean, that we managed to get, which is the STANLIB Flexible Income Fund. I've talked about it previously. The good thing about this fund is that it allocates, I mean, across different income generating asset classes, inflation-linked bonds, property, preference shares. It can also go offshore. And this helps to reduce the volatility on the portfolio. And every time, I mean, we see an opportunity like we saw recently when yields, I mean, came down quite aggressively, we were able to switch out of fixed rate bonds because we are at the bottom of the interest rate cycle and get into a mostly floating rate notes. And this is demonstrated, I mean, by this gradual, I mean, reduction, I mean, of that duration component, on the portfolio. And when opportunities arise, we're going to be having some dry powder, I mean, for ourselves to go back into the market. But there are other areas, I mean, that we can also look, I mean, to do allocations. And one area which is quite important was our allocation into property, which is why, I mean, I thought we should also have Nesi to come and provide some perspective on how that component is actually done, when we bring it onto the portfolio. So we've had an allocation in property from, I mean, the beginning of last year. So basically, I mean, that whole 30% or 38%, I mean, that we saw in property, we have actually, I mean, benefited in that because of that allocation into that. Nesi will provide some perspective on that. So this is a great portfolio, for clients. When rates are moving higher, we can manage it like an income fund portfolio. And when there's opportunities that are starting to arise, we can use the dry powder to basically get back to the fund, and the client doesn't have to worry much more, I mean, about whether they should be making any asset allocation. We do it for them. So I'm going to stop here so that Nesi can come and provide a perspective on the property sector. Nesi?
Thanks, Vic. Good morning, everyone, and thanks for making the time to join us this morning on the Investing for Income webinar. Vic's done, I think, quite a good job of sort of outlining how the various income assets are likely to perform in the portfolio. I'm going to spend a little bit of time taking you through the listed property outlook, key positioning within the sector, and also talk a little bit about why we think there is a place for listed property in a flexible fund. Maybe just to set the scene. I mean, last year was quite an exceptional year for listed property. The market was up some 38%, with listed property being the best performing asset class in SA. It's been a long while for us to be able to say that again, given the weak performance we had in the prior 2 years. I guess if we look at the property market since the start of COVID, since about October 2020 till about December last month, the property market's almost up 80%. So we've had I guess a very full and maybe complete recovery to some extent, but one must understand and unpack where some of that came from. And I think if you look at the property market, there's some key points that we need to mention there. We've had a rebasing of earnings due to COVID. A lot of that's complete. I think if you look at the rental picture in the South African property market, a lot of companies have used the COVID-induced lockdown and restrictions and the difficulty in the tenant base to restructure leases and rentals as well. I think if we look at the market, it was very unusual to have rental reversions to some extent down 10 or 15% in certain instances in segments like retail and offices. By and large, a lot of that is complete. I think the positive signs in the listed property market is that visibility has certainly improved with regard to distributions. Within the fund and typically also on the flexible fund as well, we've been preferring companies with better income prospects. There was quite a bit of hype and I guess concern regarding impairments in the property market. We as a property franchise think there'll be less of those concerns in 2022 as property valuations have stabilized. I guess as an economy, I mean, we're quite lucky and thankful that the Omicron variant hasn't led to any further severe lockdown restrictions in Q4 or for last year, which allowed retail and especially essential parts of retail to trade. I think if you look at the market and the structure, I mean, while the operating fundamentals are still fairly challenged, the capital environment certainly picked up last year with capital of about 10 billion being raised. 2022 will continue to see recycling of assets into offshore markets as the yield improves and funding opportunities present themselves. And while Eastern Europe has been a very strong destination for property companies, it's interesting to see areas like France where they have retail assets on 6 or 7% yields being acquired by SA entities. Vix maybe mentioned it, but I mean, part of the decision to go into property buzz was because we were starting to see LTV and gearing in the sector peak. We still think there's opportunities, and a lot of that's going to come from consolidation within the small and mid-cap sector, which will be done either on an NAV basis or potentially a share swap basis. So the yield is quite exciting at a 10% yield. With no change in re-rating, we're getting a 10% outlook on the market. I think in the short term, if we look at the flexible fund, there's certainly a place to have property in there, and valuations are compelling as well. Vic did mention about inflation and interest rate concerns. I guess interest rate hikes in South Africa become a bigger problem into the second half of the year. As a house, we're expecting 75 basis point increase in rates. I think a lot of clients on this call that have been invested in property to the last 10 or 15 years would be very familiar with this period between 2010 and 2016 or 2015, where property was effectively the best performing asset class in every single period through that 7 or 8 year cycle. Those were the go-go years in property. Inflation was low, interest rates were coming down, and also the consumer was in exceptional shape. There was access to unsecured credit, which drove parts of the property market. I think if you look at 2018, we saw a significant rebasing in the market. A lot of the decline in 2018 was on the back of the Viceroy events and property companies getting to a significant price to book, where those companies were shorter than the market came off. So the events of Viceroy and Brazilian Gate are highlighted quite effectively, but this year saw a significant recovery of the space. I think another thing to mention is that the benefits of having not just property, but also some of the other asset classes in a flexible fund means that you'll be able to effectively outperform cash over a 4 to 5 year period. If you look at the income component, I think we'll get a lot of questions on where's the yield in property headed, and are we seeing some normalization in that yield over time? I think it's important to remember that if you look at the returns historically, prior to 2018, you've only had 2 periods where the market's gone negative, and those have been exogenous events: the Asian financial crisis back in 97, 98, and the financial crisis in 2008. We would think income yield in the property sector should be within a narrow band of closer to about 8 or 9%, with 2 or 3% capital growth. So last year, as price to books came off, you see that massive re-rating or acceleration in capital. Going forward as a business and a property franchise, we expect the capital component of property to be a lot muted. If you look at the return performance across shares, and this is why active management and stock picking is quite key, not just in the sector, but in the contribution to the flexible fund, is that there were wide divergences in performance. Now, we expect this to continue to occur through the remainder of 2022 as companies position portfolios differently, but also companies take different allocation decisions with regard to capital. The smaller, less liquid funds re-rated quite aggressively last year because in the previous year they were down quite a bit by 60 to 70%. But you see the large caps in the middle, and typically your growth points and your redefines up anywhere between 40 and 60%. So a nice recovery of that earnings base. But it's very important to realize that some of these, that not all portfolios are like. Some companies do have office assets which they're looking to sell, and I'll touch on in the next slide. I guess the view on the market is quite important for the coming in the next 3 to 4 years. At a very high level, we like certain parts of retail. We like the lower end of retail where we think food is a bigger component, and you're not going to necessarily see the stress at that end of the market, because a traditional lower LSM retail center has about 30 or 40% food as an anchor. The nice thing about retail this year is with less lockdown restrictions, you're getting to see normalized footfall and trading densities. So people are going back to shopping centers. Average basket sizes are increasing and trading densities are increasing as well. Asset valuations have stabilized. We saw big write-downs in large super regional centers, which are 90,000 meters squared last year. You're not going to see some of this in 2022. Online did have its day in the sun. Online sales did increase during the start of COVID, but they've started going back down to below pre-COVID levels as well. And just to highlight that South Africa has a 2-tier retail market, and at the lower end, online doesn't really feature there. Offices, we could spend an hour talking about offices, but we're quite worried about the office outlook in the short term. We're worried because of remote working. There's corporates that are giving back space. And while the hybrid model will start to take hold, I guess, as some companies do bring staff back, you're going to see maybe 10 to 15% space that goes back to into the supply pool. There will be less supply in P grade because no one's going and building large 40,000 square meter head offices anymore. And property companies in that listed space, you've seen it with Redefine and Growth Point, will look to do office to residential conversions. Most companies in the office that have office assets are looking to sell. So it's our least attractive asset on a longer term basis. Logistics, we've loved for a period of 3 to 4 years. We continue to see that as an outperformer in the sector. While rentals are firm, we have a strong view that cap rates will come down in the sector. And potentially with demand for e-commerce increasing, these companies will look to recycle offshore to buy logistics assets. The residential might be a tough year with increasing interest rates in the second half of the year. And if rates do go up, I mean, controlling bad debts for resi companies will be a big focus area. The resi companies will try and grow better quality assets, particularly with the shortage in student accommodation. Storage is another sector that has been uninterrupted, I would say, by COVID. Rentals have been firm, vacancies have stayed at similar levels, and they continue to have a very attractive development pipeline. And in fact, if you look at the escalation in some of those storage assets are up about 7 or 8% lease escalation growth. That said, I mean, the development market still continues in certain subsectors. The big companies like Equitas are doing exciting developments and building logistics assets at an 8.1% yield at Waterfall. Growth Point is doing their residential development down in KZN. That's almost 60 or 70% let. Vukile, which we hold as well, is doing a redevelopment at an exciting yield of 8.3%. So there's a strategy here for companies to continue to do development where the growth potential is there, and potentially where they can get quite an exciting yield relative to where their funding costs are. I think if you look at capital in the market, I mean, this is something that was quite interesting last year, that the prior year we saw capital raised off at about 8 billion. 2021 was about 10 billion. Now, companies use the DRIP mechanism to try and return capital to shareholders to satisfy the payout requirement. A lot of that cash that was retained on balance sheet was used to de-gear. You're finding there's probably 5 or 6 companies in the sector that can go in aggressively and raise capital to fund deals. And that's been in the Australian market and also in the flexible space with the likes of Sirius in Germany. So a lot less concerns we're seeing in the market regarding capital. In fact, the one thing I would say is that companies will start looking at share buybacks in the property market as the yields still look cheap, and they build up a significant bulk of retained earnings. But that number was on the strong side for 2021, and we think optimistically we could get to 8-9 billion plus in capital raises for the year ahead. The wild card, I guess, for the property market and also all financial assets in SA is that how sharp is this rate hiking cycle going to be? We've looked at the property performance relative to rate hikes going back over a period of 17 or 18 years. Property tends to underperform these other asset classes 3 to 6 months before the first rate hike. But once you into that rate hiking cycle, the property performance comes back very strongly. And in previous periods, once you've done that first or second rate hike, it's not unusual for property to do 10 or 15% after that. Another thing to maybe mention is that the property companies have been proactive with balance sheets in their fixed a large proportion of debt. So shorter duration leases can reprice quite quickly and become very attractive. I think maybe just to position, I mean, the benefits of having property in a flexible fund in that you don't just have access across various subsectors in residential, and retail and logistics, but you also have diversification across geographies as well. If I look at the OP, 45% of earnings come through from the offshore market, while 55% is local. If you look at the yields and the discount to books, still very attractive, and there's probably another 10-15% buffer to where we think fair value in price to books could go to. It's a lower cost exposure for us in the fund. As an investor in the flexible fund getting property, you don't necessarily have to allocate 250 million to buy a logistics asset down in KZN or Cape Town yielding 9 or 10%. You can do it quite cost effectively through the fund. Property correlation has been lower than bonds the last couple of years. It used to be high 10 years ago, but I guess the diversification offshore has reduced some of that correlation. It still is an inflation hedge if I look at the leases now in the market. The exciting thing about property is that what's happened in the global property space with access to new centers like data centers and towers and healthcare REITs will start to become new listings in our market pretty soon. So just maybe to conclude before I hand back to Vic, 2022, I guess concluding should be a lot better than the last 2 years, given the disruption we've had in the market. There's probably going to be less restrictions now in 2022. It's positive for things like hospitality assets as well, once the orders are fully open. Lower gearing, we think there's a 3 or 4 year journey where these companies get back to 37% or 36% LTV from the high 40%. Recycling in the market will continue across all of those subsectors, but these companies are building hard currency earnings. If you add the liquidity and rate increases together, the balance sheet is a lot better for these companies now versus 2 or 3 years ago. valuations are still attractive. And this is a sector where we think there's good yield going forward. Thanks. So Vic, you can go through that conclusion.
Okay. Thank you very much, Nesi. So I just thought maybe just before we get to the Q&A session, which is quite important, I should show, the outcomes, of some of the work that we have been doing on this portfolio, especially, ever since we introduced, more asset classes. This is a fund that benefits from all, the ideas within fixed income, ideas, within the property sector, but also generally from the tactical asset allocation meetings and other engagements, that we have at STANLIB in general. So this is how the fund performed the last year. You can see, generously beating the benchmark, but also delivering on its return. That beats inflation over all major measurement periods. Quite handsomely. So it's a very good portfolio, for environments like this where there's a lot of uncertainty. And given our active management style, it does benefit in the sense that we can switch and move in between asset classes as and when we see opportunities. So I'm just going to conclude here before Alan comes in, by again, just highlighting that this portfolio is really about asset diversification. Basically, the returns that you get would tend to normalize, some of the volatility that basically could come because of the lowering of correlations, as and when we introduce other asset classes. So for example, if inflation is going to become a big problem, maybe over time on our side, we could basically allocate into either the currency side or even inflation linked bonds. So yeah, we are going to continue to actively manage this portfolio, for better returns, for our clients. So we're going to get into the Q&A session. So Alan, you can, basically take over from here.
Thanks, Vic. Appreciate it, and thanks, Nesi, as well. And I hope you all enjoyed the discussion. So for the next the balance of the webinar, we're going to just have a Q&A session, as I said right up front. So the first question that I'd like to pose, Vic and Nesi, is it's just a question related to the correlation between bonds and property. And obviously, if we go back a few years ago, the correlation between the two was, the highly correlated. But obviously, through the last few years, volatility in property and where we sit at the moment, the correlation is no longer as aligned. So just a view going forward, and Nesi, if you want to maybe take it, or Vic, just in terms of your views on the correlation between the two asset classes going forward.
Yeah, I'm happy to kick off. I guess if you look at property over the period 2010 to about 2013, 2014, there's a very high correlation between listed property and bonds, as high as maybe 80% plus. If you look at the diversification of the OP over time, from 2013, 2014, there were a lot of listed property companies that were starting to go offshore into Eastern Europe, particularly Romania and Poland, and also look to diversify the portfolios into Australia and the UK. That had meant that to some extent, correlation between bonds and property did decline. There was a big dislocation in 2018 with Resilient and Viceroy, and also with COVID as well. So correlations are lower. I think over time, if you look at it, correlation should start to pick up again. Property income yield starts to normalize. One must also remember that the way the valuers in the market look at valuation of properties, they use something called a capitalization rate, which is effectively a risk spread of a spread of the risk-free rate, which is the bond rate. So correlations we think would pick up over time, but we don't think we're getting to an environment where it's going back to 90, 80, 90% plus.
Okay, thanks, Nes. Appreciate it. Maybe just building on not necessarily on that question, Nesi, but there's been one or two questions for existing investors who've obviously been in property as an asset class, and obviously Vic and team have included, and reflected in the presentation, the active allocation to listed property over time, and obviously our current holding. But for investors who've been in domestic property for a period, say 3 years, etc., who've kind of had a period of underperformance, and then we look at how the asset class ran last year. If you can maybe just give a view, and you've touched on it briefly in terms of 2022, but maybe just a message to our financial advisors on the call who kind of have had the pain of underperformance, but have obviously had the recovery of last year, but maybe net zero. If you can maybe just touch on that. My specific question comes from Andrew and a few others.
I think that's a very good question, because I mean, if you look at property as an investment class, I mean, we have leases in the logistics sector that are 15 years. We have leases in the residential sector that are 8 or 9 years. So for us as a business, I mean, the property investment horizon is at a minimum 5, and I would say even now with the duration of leases going out, we would probably say 7 years plus. So for an investor in property, I think what you need to manage is that two things: that property is a long duration asset class. Typically, if a retail fund is doing development, it takes 2 to 3 years, I mean, before the stuff is even built, and maybe a year before it becomes income into the fund. So I would say, if I look at the fund over the last 15 to 20 years, the compound annual growth is maybe about 11-12%. For those investors, I think you can't be chopping and changing your asset allocation. I think we had a down market in 2020 on the back of COVID, but we had a strong recovery as the property companies rebased. And I think the overriding message is these companies were in bad shape last year because of the high debt on the balance sheet. A lot of them have fixed their LTV problems and have brought debt down to very manageable levels now. And covenants, and I look at also covenants on interest cover and gearing are back at very acceptable levels. And I think it's important that the stock picking that's done in the fund is in those sectors that we see as growth, which will do well on a 5 to 10 year view.
Thanks, Nes. Vic, the question for you, I mean, obviously, as we position the portfolio and your team from a bond management perspective, is that obviously active duration management is a critical focus of you and the team, yourself, Sly, and the rest of the team in terms of how you manage our various portfolios. One of the questions posed is that if you look at your anticipated interest rates hikes during the course of 2022, it's quite different to what the FRA curve is anticipating. So, I mean, maybe if you can just kind of, and I know you touched on it briefly, but the question really relates to the reasoning around that, number one. And number two, if you look at the Flexible Income Fund and taking that active management and duration management into consideration, are you and the team, or have you and the team taken advantage of that kind of call based on what your views relative to the FRA curve?
Yeah, thank you very much. I mean, for that question, Al. So yeah, indeed. I mean, our view is different to what the FRAs are calling for. I mean, in terms of interest rates. So I think, I mean, over the next 12 months, they were calling for about 190 basis points. I mean, of increases from the Reserve Bank. You know, I mean, on our side, we think that's way too aggressive. And way too aggressive, I mean, for an economy that is still struggling to grow. It's still having some issues, I mean, with respect to the output gap. And most of that, I mean, can be seen, especially if you start looking on the demand side of the economy, you know, where your core inflation, as I mentioned earlier on, I mean, it's still lingering around your 3.4%, you know. So it's an economy that still needs some support, but we do, of course, I mean, accept that the Reserve Bank cannot just sit it out, you know, when other central banks are increasing rates. I mean, across the world, they also have to increase so that they can start to look attractive. But the reason for increasing rates on our side is not the same reason for increasing rates in Brazil. I mean, where we saw inflation basically, getting to above 10%, and their inflation targeting, was basically sitting around 3.7 to 4%. So they had a substantial overshoot. Over their inflation target, which is why at each and every meeting they were even increasing interest rates by 150 basis points. We don't have those issues. If anything, even though today's inflation number is slightly higher than what was expected, when you look at the overall picture, it's not going to get out of hand. It's still going to be controllable. And the way that we play it in the market, obviously, it's switching between fixed and floating. If we think maybe the market is oversold, for example, then we would get more into fixed bonds. And if it's cheap, then we would cut them, like I showed them earlier on, cut the fixed bonds, back to floating rate notes. Or you could also play that also in the floor markets themselves. But those gaps, we are continuously monitoring.
And just a follow on, maybe it's a point, but just for you to reiterate, I know we're chatting the flexible income, but there's been one specific question from France, which is around the balanced cautious fund, which I positioned up front, or the two kind of low risk multi-asset portfolios, flexible income and balanced cautious. Now, your active management in terms of how you manage in fixed income would obviously then, clients in the balanced cautious fund will benefit from that as well as you actively manage the kind of duration across the bond market. That's 100% correct, right? Just to confirm.
Yeah, it is. And that's the benefit that clients get when they are invested at STANLIB, because of the products that we have. Herman and team, they can also, access that active management, through an allocation, and the clients do not even have to pay more fees, basically, to access, Yeah.
Okay, thanks, Vic. Nesi, I'm going to come to you. Don't worry, there's one more question to Vic, and then I'm going to ask you a question. Is that it's a question around the kind of potential policy changes in the US by the Fed, Vic. And the first question, which I think is kind of, you can answer, but is, when the Fed's looking to manage monetary policy within the US, and there's obviously going to be potential knock-on effect into emerging markets. The US Fed is looking to manage the US from an economic perspective, which would then potentially have a knock-on onto emerging markets. But the question is, what would that specific impact be if we see a significant interest rate hike in the US on our bond market and currency? There's a few questions on the currency as well. So if you can maybe just give a view across bonds, and then also how we would perceive or what the impact potentially of a change in interest rates within the US have on our currency as well.
Yeah, so like I said, earlier on, it really depends on how it is being done. Whether it's surprise moves. For example, they increased by 50 basis points, or they increased maybe much higher than what would have initially been thought. That if it happens like that, then it's going to create a lot of volatility to the market. It's going to strengthen, the dollar, substantially, and have an impact on emerging markets in general. But it's really going to depend. For those that are probably looking maybe for exposure in emerging markets, it's really going to depend on what sort of emerging markets you're looking for. So the ones that would probably be swimming naked are the ones that would be running current negative, current account deficits, and also negative, budget deficits. Then you don't really wanna touch those. Because the impact on those are actually gonna be more. So emerging markets that have got credibility in terms of managing also, their fiscal space are more likely to benefit, than the ones where they don't have a proper discipline, on that. Kind of like similar to what you were seeing, for example, in Brazil, where one of the main risks was that the president was probably going to become more populist, because he was facing maybe some challenges, politically, So as a result, markets then tend to react in a very wild and volatile manner. So for South Africa, in order to avoid that, we need to continue to manage the fiscal space better. But but also given the windfalls, that we've had last year in terms of revenue collections, South Africa also needs to accept that in order to create sustainability in the future, we have to have reforms. If those reforms don't come through, then certainly an aggressive response, from central banks is going to be quite negative for our markets.
Vic, the carry trade has always been an attractive element for foreign investors into the SA market. Do we continue to see or expect to see strong foreign investor flows into the South African market if we see a change in the Fed's kind of interest rate view, etc.? What is your view? That's a specific question related to that.
Yeah, so the carry trade makes sense in an environment where there's a lot of froth, for example, in the economy. You worried more about deflation, for example, so you end up with yields in developed markets, which basically anchor yields everywhere else, starting to move towards zero, and some of them basically below zero. But these investors still have to deliver decent returns to their clients, and then as time progresses, they end up investing in some of the higher yielding markets, including ones that they ordinarily wouldn't have been interested. So that's how the carry market works. So this environment now, compared to the carry market that we saw after the global financial crisis, it's still slightly different, given that inflation in the US, for example, it's even higher than inflation in South Africa. And now there's expectations that inflation might actually stay a little bit higher, for longer. As a result, we see US yields basically moving higher towards the 2%. So it does create a bit of a challenge for carry trade, because someone might look at the two markets and say, but I can go and buy US bonds, get some safe haven and 2%, and I don't have to worry, And this is different to when US yields are basically sitting at 0%, and there's a requirement for me, to deliver some positive return, for the clients. So it's a different environment.
Yeah, appreciate it. And Nesi, a few questions. I know we've chatted domestic property today, but we've had a few questions just on our view on global property as an asset class. Maybe if you can just give a brief kind of overview, an update on your and the team's views on global property as an asset class.
Yeah, so I think if we look at global property, and if we go down to subsector level, we still like residential, industrial, and storage as the broad sectors within the global property fund. If we look at the property sector return outlook, we're expecting income yield of about 4-5% in US dollars. If you add on top of that rand depreciation of about 4 or 5, you get to a 10%, let's call it ZAR return for global property. So slightly less than the local market. I think the key thing to remember with global property, that in a low to moderate inflation environment, it tends to do better than other sectors and other funds across the board. We think the US will be a strong outperformer versus other markets, but that's just because of an earnings recovery in some of those REITs. We think the US REITs will probably be a lot more compromised when it comes to things like retail. And also, US office funds are likely to have underperformance versus the big European funds. So in a low inflation to moderate inflation environment, global REITs do well. With high inflation, you're going to see some stress on the dollar return for global property. We still like local relative to global in the flexible fund.
Thanks, Nes. Appreciate it. A question related to ESG, and obviously a very important component in our asset management business and across your teams and the rest of our investment teams. The question relates specifically to green bonds, Vic, and how you and the team, apply the ESG lens into the fixed income markets. Maybe if you can just touch briefly on an ESG component in fixed income, and maybe Nes, if you just want to touch on that from a property perspective as well.
So we've got an ESG framework or tool, which we use, when we are making decisions on investments, that we bring, onto the portfolios. I mean, there are certain thresholds, that help us to decide whether this should come in or not. So, but to cut a long story short, when we do investments, I mean, we take ESG into account for each and every counter that we have, because I mean, for us, it's also about not just getting returns, but getting returns that can actually be sustainable, over time. And green bonds, so ESG and green bonds, I mean, in South Africa, in comparison to, say, maybe in Europe, most of this, it's still in infancy. It's something that is actually starting to develop. Last year, there's been a lot of interest, I mean, from an issuance perspective, but it is not as broad as one would want it to be, But I would like to think, I mean, over time, in order for this market to develop, we're going to need to build, or the market, I mean, it's going to need to build some products, I mean, around that. It's a very interesting development. I mean, companies that issue, for example, in Europe, in the green space, I mean, they actually do tend to issue cheaper than if they if they are issuing a non-green bonds. Even a central bank like the ECB, I mean, by the way, they also have a portfolio that just invests, for example, in green bonds. So it's a theme, that is coming in quite strongly, and yeah, we remain quite ready, also on our side. And this is something that we anyway already doing.
And I guess
I want to just a quick 1 minute overview before we just. I want to ask one last question before we wrap up after this.
Yeah. So just on the property side, I mean, we integrate ESG into the property rating framework. We score all the companies on 5 or 6 different ESG factors, and we're able to build that into the risk discount rate. If I look at the green bonds, I mean, you had NEPI that did a €100 million issuance. You did Mass Real Estate that did a green bond. And these are particularly backed against buildings that have to meet certain criteria in terms of water, solar, energy reticulation, and renewables. The property companies do get a benefit in terms of lower funding costs. If they issue these green bonds, are able to achieve some of those targets. So that comes out into the distribution line. But more and more, you're seeing property companies issue these bonds against the green buildings, which are now certified as well.
Yeah, and
thanks. Yes, Vic.
I was just going to also say that around ESG, although I mean, obviously we're doing ESG, other franchises are also doing ESG. This is something that is also quite important. I mean, for STANLIB, and it's also being driven from the center. The head of investments office. Where they're driving that outcome directly.
Thanks, Vic. Appreciate that. Thank you. Just quick last question before I wrap up. Just a question related to the different asset classes and potential returns going forward. So the outlook on just returns, taking into consideration the environment that we've chatted about today. I mean, Vic, do you want to just give a quick kind of view across, bonds, ILPs being asked, and Nesi from a property perspective, and now I'll wrap up.
Yeah, so I'll just touch on the major ones. I mean, that mostly explains, I mean, the variation of returns, in portfolios like this. For bonds, like I said, I mean, we are expecting 15% on that. Obviously, there are some risks, I mean, around that. Inflation-linked bonds did very well last year. I mean, returning 15%. But in our latest views, I mean, that like Robin in our inflation space did, he's expecting inflation-linked bonds to return 9%, on the plot. And I think this is going to provide, I mean, the return for.
I think in property, if you look at a base case view where Vic and the team has bonds going out to 9.25%, in that environment, property can deliver a return of 10 or 11% at a very base case view with 9% income and 23% capital. I think longer term, if you look at a 4-year view, at bond yield level, property could do 14%. So you're not getting the high 30% that you got last year. You're getting a more subdued, normalized return because the earnings have been rebased.
Okay, thanks, Nesi and Vic. Ladies and gentlemen, we're out of time, so I know we can carry on chatting, and the Q&A is always extremely valuable for yourselves and ourselves. So I do appreciate all the questions. We've had a really large number of questions, huge number of questions. We haven't managed to get to all of them. So I do commit where people have got their names on the questions you've sent through, obviously a little bit difficult on the anonymous ones, but where we've got names attached to the questions, we will get back to you. Where we don't on the anonymous ones, I'll bring them into our roadshow, which I'll touch on briefly. But I mean, I think just wrapping up today, thanks very much for the discussion and presentation, Nesi and Vic. I hope all on the call have got value out of the discussion, the information and the views across the different asset classes we've chatted about. And for those invested in the fund and if you've got clients invested, really appreciate it. And we hope that your decision to invest in the Flexible Income Fund is endorsed, and we hope that going forward, the team continue to generate the performance relative to benchmark, which obviously meets you and your clients' objectives. So from an event perspective, our next event will be our roadshow, our STANLIB roadshow, which is a virtual event on the 9th of February. You should all have received the invite for that. Please, if you haven't, get in contact with us so that we can send you that invite. And we're hoping, obviously, as usual, that we meet your expectations in that roadshow. We've got a really good lineup planned for that. And I think some of the questions that we can't get to from an anonymous perspective, we'll try and weave into the discussions and the panel discussions that we have at that roadshow on the 9th of February. So once again, on behalf of myself and the rest of the team, Vic and Nesi and the rest of the STANLIB team, thanks for your support, and we look forward to building on our partnership into 2022. So keep well and keep safe, and we'll chat again on the 9th of February if we don't chat before then. Thanks very much for joining us.